Let's now bring in Greg Ip, the chief economics commentator at the Wall Street Journal, to break down more of Powell's rhetoric and speech from today. Greg, you heard what Steve just kind of laid out in terms of the scene setter out there in Jackson Hole and what exactly was the primary driver for the downside moves here. Is this a scenario where the Fed's credibility maybe is no longer in question, or do you think that there are still questions surrounding whether Powell has the resolve to conquer this inflation issue?
Well, I think the fact that it was a compressed, concise speech and that every word of it was clear and unidirectional. We're going higher, even if there's a recession. The power of that statement and the very concise nature might have just been enough to kind of like break the spell on the markets. This belief that, as Steve said, has been completely contradicted by every Fed speaker in the last few weeks, that they were going to pivot. And maybe that's it. Maybe it's because they had to hear it from Powell's lips that this was not going to happen. That said, Dom, there's something about this that puzzles me. It was obvious to most of us that the bond market got this a while ago. And in fact, if you look at the Fed funds futures, there's almost no movement in the probabilities in the next few months. They're still looking at about 60% for 75 next month. What I don't understand is why it took so long for the equity guys to wake up from their dream, right? I mean, never mind, why did the Dow drop 1,000 points today? Why was it up as many thousand points as it was in the last few weeks?
Oh, and not just Greg, if I might follow up on that, Greg, the reason why I want to do that is because we've been showing viewers and listeners on SiriusXM, what we've been showing is the entire slate of Treasury note and yields and all the information that we've seen from price action. And Greg, the thing that struck me about today's action was the complete lack of action. Forget about the spreads or anything else. I mean, just look at the 2-year note, the 5-year note, the 10-year note, and the 30-year long bond actually dropped, right? And maybe you could make the argument there that there's a little bit more of a long-term economic slowdown fear, so longer-term bonds are being bought up for safety. But what was it about the bond market that maybe the equity markets didn't see coming, right? If the yield on the 10-year long bond or Treasury note only moves up by 3 or 4 basis points on that kind of a speech, what does that say about the dislocation, Greg, in your mind, between stocks and bonds?
I'm even as I sit here, I'm actually trying to come up with a coherent explanation for all this behavior. And first of all, my casual observation was that the 10 and the 30 may have had a bit of weakness early in the morning, but that towards the end of the day, they maybe rallied a bit. And there might have been a little bit of that flight to safety, a little bit of that old flight from risk there. And I suppose if you sort of squint hard, you could tell a story about how there's a belief that the Fed's resoluteness, the willingness to cause a recession in pursuit of 2% inflation, makes it more likely that equities will sell off and we'll have a recession, but also more likely that the Fed will be back to easing mode a couple of years from now. I mean, does that sound a little bit kind of like convoluted? I guess so. Maybe that's one story. I don't know. What do you think, Steve?
I want to tell you about an email that I got from a market participant who everybody knows, but I figure it was an off-the-record email. But the person said the Fed doesn't know now that it's going to have to pivot later. There's a certain hubris inside of that, which is to say that they know that this person or even the market knows better what the Fed is going to have to do than the Fed itself. But then I sort of talked about that with a Fed official today, and the person said, well, can you blame them? And this Fed official was referencing the sort of pivots that the Fed has made of recently. If you remember, it was we're not thinking about cutting rates, and so or hiking rates, and then they announced these series of rate hikes, and then they bumped it up, and then they had one idea about how fast to reduce the balance sheet, and they bumped that up too. So there has been some back and forth from the Fed, and I think, Dom, when you asked that question about credibility, and then Greg made the point about how short the speech was, I do think perhaps there's an effort here by Powell to claw back that credibility. Let's not forget what Powell was saying this time last year. He was talking about the idea that he expected inflation to moderate, that it was transitory. So I kind of get the idea, but I could not have reported more clearly, I think, this idea of higher for longer. As Greg said, from every Fed official, we interviewed every Fed official that talked. They leaned against this notion of these rate cuts, of this quick pivot. And so it was a little bewildering, but you can maybe understand why the Fed was not taken at its word by the market.
All right, we're going to spend an entire hour.
Can I just make a quick
okay, Greg, last word to you here.
Sure. So I think going to that comment, Steve, that you said the Fed doesn't know it has to pivot, there's a Hall of Mirrors factor here, which is the more the market rallies, the easier financial conditions get, the more the Fed has to tighten. So the stock market doesn't realize it, but the stock market selling off the way it did is a necessary but not sufficient condition for the Fed to eventually pivot.